Hello, everyone, and thank you for joining us. My name is Richard Wabican, and I am the Associate Dean for Business and Government Relations and Senior Economist at the University of Colorado Boulder's Leeds School of Business. Welcome back to the second day of our 56th Annual Business Economic Outlook Forum. Each day this week, one of our Leeds Centers of Excellence is hosting a panel session on business and the economy. For today's session, we have the CU Real Estate Center with the title, Now What? A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask, please send us a question through the Q&A interface. We will monitor questions as they are submitted, and the panel will respond to them throughout the presentation. As a reminder, for optimum audio quality, we do have everyone on mute except for myself and our speakers. If you experience any technical difficulties during the webinar, please notify us through the chat interface and one of our support specialists will touch base. Lastly, a link to access the recordings will be sent to all registrants next week, along with a survey link and supplemental resources from today's presentation. Before we jump into the session, I would like to recap a few points from the economic outlook presented yesterday regarding the real estate industry. The residential real estate market was bolstered by record low interest rates. However, the commercial real estate market has been significantly affected by the changing work environment, and long-term effects still remain to be seen. The migration from the urban core to suburbia that began in 2015 is expected to continue, driving demand for apartments, homes, retail, and offices outside the city. While demand for housing units remains strong this year, both single and multi-family building permits are expected to fall in 2021 as COVID-19 has a lagging impact on the industry, and there will be slower migration into the state. Now I am excited to introduce today's moderator, Mike Kercheval, the Executive Director of the CU Real Estate Center. Welcome, Mike, and thank you so much for being here and assembling this panel.
Well, welcome everybody, and thank you very much, Rich. And also thanks to the Business Research Division of the Leeds School of Business for carrying on this important work now in this forum's 56th year. The CU Real Estate Center is honored to be invited to again host this discussion. And the CU Real Estate Center is part of the Leeds School of Business. It's self-funded through support from the real estate industry and a series of endowments. The role of the center as one of Leeds Centers of Excellence is to foster thought leadership in the real estate industry, facilitate lifelong learning for real estate professionals, and support academic excellence through CU's undergraduate and graduate real estate programs. To start things off today, I thought it would be useful for our panelists as well as for our audience to just do a quick poll of who's joining us this afternoon now, and also some of your immediate perspectives of the real estate industry. We had just shy of 800 people signing up for this today's program. So if you wouldn't mind, just jump on this poll right now. And how would you describe yourself? As a real estate participant, like an investor, developer, maybe an agent or a broker in the real estate industry? Are you a public official or a member of a government entity? Are you an academic, including students? Or you're involved in some other form of non-real estate business? So that's great to see. We have a nice mix of people. I'm always pleased when we see that there are a number of non-real estate people on these participating in these sessions, because real estate is so important to the overall economy. So I have one other question, if you wouldn't mind taking this poll, and Laurel, if we could see this. This asks, what's your outlook for the Colorado real estate sector? And this one's pretty easy. Are we up, flat, or down? And I can tell you in taking the poll, it will no way influence these panelists' conversation. Oh, this is wonderful. Rich, you should have had this information yesterday. So the majority by far say we're either headed to a recovery or just a little no growth. And I think that's pretty good. Those few people who think that we're headed for a crash, I think there's probably some arguments that you could make for where there is weakness. But overall, I think as we'll talk about today, the Colorado real estate market seems to be holding their own. So now what? Our task today is to cover a wide range of issues critical to the Colorado economy and the real estate industry. To listen to yesterday's comprehensive and very detailed outlook for the overall economy, there weren't a lot of bright spots, with maybe the possible exception of the cannabis industry. Even commercial real estate, which is generally an engine of growth, it came out as being a bit challenged. Vacancies are up and rising, absorption is down and falling, tenants failing, residents bailing on Denver, new construction only holding its own due to projects already underway, and hotels shuttering left and right. Today, we've assembled an impressive panel of world-class experts who will offer a slightly different and perhaps more nuanced view of the real estate industry. Among the issues that we will address today is what should we expect for the Colorado and the national real estate sector in the year ahead? How does all of this wrap around some of the post-election questions and pressures? The COVID recovery, calls for social justice in our communities, Colorado's legislation, including the Gallagher Act, technology and other disruptors. And I think we'll have a little time to also talk about what's hot and what's not in the real estate sector. So let me briefly introduce our luminaries. Jessica Ostermick is director at CBRE in the firm's Capital Markets, Industrial and Logistics Services Group in Denver. Her solid reputation as an insightful thinker and researcher has been honed over the last decade and a half. Prior to her current role, she was CBRE's Director of Research and Analysis for the Colorado region. Today, she focuses on client, investor, and owner opportunities within the industrial and logistics marketplace. I will tell you that earlier in her career, she was a research economist with Development Research Partners and was Director of Business Development for Oz Architecture. Today, she serves on the Colorado Governor's Revenue Estimating Committee, is a member of the Urban Land Institute and the Denver Association of Business Economists. A graduate of DU's MS in Real Estate and Construction Management program, she earned a BS in Business Economics from Miami University of Ohio. Welcome, Jess. Darren Powderly is the co-founder and vice president of capital markets for CrowdStreet, a prop tech, fintech entrepreneurial firm that he founded in 2012, really after identifying the need to radically improve people's access to commercial real estate investments via technology. Over Darren's 20 plus years career, he's transacted billions of dollars worth of commercial real estate investments and contracts. He's also personally owned commercial real estate, syndicated investment groups, and developed properties from the ground up. Prior to founding CrowdStreet, Darren served as president of Compass Commercial, a full-service commercial real estate services company. I'll tell you, he launched his post-college career at Oracle ATG in San Francisco, but he started his first profitable business at age 19 in Boulder, Colorado. Darren is a graduate of the Leeds School of Business at the University of Colorado, a CCM designee and a member of the Urban Land Institute. Welcome, Darren. Paul Books is the president of Palisade Partners, a firm that he founded in 2009. As you may recall, that was in the middle of an economic recession. As a contrarian, Paul seized upon the opportunity to purchase and renovate existing multifamily real estate, and then quickly moved on to developing new construction of apartments and townhouses. In 2013, he began working extensively in the Five Points area of Denver, where he found his true passion for community-centered development. He's been on the Five Points Business District Board since 2014 and was instrumental in creating the Five Points Business Improvement District, of which he's now the president. His projects have delivered much needed affordable housing, daytime activation, and inclusive retail uses, all of which preserve and showcase the rich African-American history and culture of that community. At the same time, Paul began overseeing the development of Summit Sky Ranch, $250 million high-end single-family residential development in Summit County. He, however, applies his same passion for community-focused development in the mountain communities that he is providing to Denver. A graduate of DU's Master of Science in Real Estate and Construction Management, Paul received a BA in Economics and Math with a finance sequence from Claremont McKenna College. In addition to serving as the 5 Points Business Improvement District President, he's a member of ULI, the Colorado Black Chamber of Commerce, and a former board member and chairman of Historic Denver. Welcome, Paul. And Chad Brue is the CEO and founder of Brue Baukol Capital Partners. He's responsible for new and existing capital relationships and management of the firm's strategic business initiatives. Chad has honed his experience over the last 2 decades in the real estate sector, chalking up over $1 billion in commercial real estate transactions. And while as senior managing director of CBRE's National Private Capital Group, the PCG, he oversaw 350 commercial real estate brokers. Chad is actively involved with the University of Colorado Real Estate Center and has been a long supporter of his alma mater, the University of Colorado Boulder Leeds School of Business, from which he received a Bachelor of Science degree in entrepreneurship and small business management. Chad is an avid golfer, outdoor enthusiast, and global adventurer. And we're glad, Chad, that you could take some time out from that busy social calendar to join us today. So welcome to all of our panelists. I'm going to start out with you, Paul, and we're going to start out by taking a quick look at the individual real estate sectors, the office, the retail, the industrial, the hotels, and kind of get a sense of where our experts believe that we're headed in those sectors. So Paul, on the office sector, yesterday we heard that vacancies are rising and they're continuing to rise. And Seville's, in their third quarter report, said that leasing activity in Denver's fallen by 1 million square feet, the lowest point in a decade. There's 1 million square feet of sublease space has come to the market, bringing total to 4.5 million square feet. In addition, they report the office vacancy rate in the market has increased to over 20%, which is the highest in 8 years. You're doing a lot of work in downtown Denver. You see that market every day. What's going to be the new norm for downtown Denver's office market in general, and for office employees?
Thank you. Glad to be here today. Jumping to the office, we're not extensive in office, but we've got 35,000 square feet that we're currently trying to lease in a project that's in development that's scheduled to be delivered in June. And I have to admit that it dropped. The interest has dropped precipitously, so much so that we are even exploring taking one of the floors of the office space and converting it possibly to additional apartments, because it's part of a mixed-use project that already has 103 other units. So with that obviously comes challenges with parking and other challenges, but we are certainly looking at that extensively. And I would say, though, that in the long run, that we're going to probably see what we're seeing right now, through May, June. And then I think the recovery will begin. I do think in the long run that there still is going to be a place for office and for gathering. I think possibly it will evolve, and how the layouts get created, and maybe maybe people won't be in the office 5 days a week. They might only be in the office 2 or 3 days a week, et cetera. But so I think it will return, but I think we're going to be in a challenged environment at least through May, June before we start to see real recovery there.
Well, I'll just add to that, Mike, too, that there is a little bit of a tale of two cities here, which we'll talk about probably throughout the entire presentation. Is the tale of two cities is there is a difference between an urban office and a suburban office. We're seeing more demand in the suburban markets where you can spread out a little bit more. You're not in a high-rise office building. And so I think, we may see actually a spike of activity and an increase in activity in suburban markets across the country, especially Denver. But we will, as Paul was saying, we will see a decrease in urban environments. Additionally, I'll just say, you look at markets like New York City, or you look at markets like San Francisco or Chicago, if we compare this to the 9/11 in 2001, there was a lot of exodus that was coming out of these high-rise buildings because of the threat of terrorism and future terrorism. And then it slowly came back. And now New York City, or I shouldn't say now, pre-COVID, New York City was back to normal again. I think we'll see a similar trend here. The pendulum will swing too far for like urban office, and it'll start to swing back and people will start moving back into urban centers.
Hey, Darren, do your investors believe that? Do they believe that office is going to come back?
They do. You know, Mike, we work on office nationwide from, you know, New York City down to small tertiary markets. And I think that Paul and Chad are correct that, you know, office is here to stay. I mean, it's just, I think personally the net and some of the data, you know, would support that. We've got a net decline in the need for office. A lot of people say, well, with social distancing, everyone needs 6 feet. And so the square footage per person will increase and it'll offset, maybe it'll be a neutral. I don't believe it'll be a neutral. I think that there's a hybrid model where many of us are happy working at home. It's more efficient. We get to save from our commute times and we get to eat lunch in our kitchens and maybe you can see our kids from time to time. I do see some population of people who are dying to get back to the office. It's bosses and single young people that are bored, or maybe they live in tight quarters and they want to get back to the office. And especially if you have a cool office and a cool environment. And then there's a lot of the rest of us that are kind of in between, where we appreciate the freedom that we have now experienced and really don't want to give that back up, you know, in a post-COVID environment. So I think we're going to see some net decline in the overall need for office, generally speaking, nationwide, with some places, you know, suburban offices held up pretty well in growth markets. And you know, we'll be back in the office before long, you know, hopefully in the second half of 21.
Well, I'll just quickly add too, sorry, Jessica, I'll just quickly add too that there's a lot of CFOs and CEOs that are making like short-term decisions right now to say, let's just kick the can down the road for a year. We just did it in our office space to just extend for a year just to see how the world evolves. So I don't think there's very many tenants out there that are making 10-year decisions right now in the midst of this pandemic. So
I'd just add, Darren, to the group of people that want to be back in the office, I'd say moms with kids who are being homeschooled and people who need to get away from them.
That's so true, Jessica. So true.
I was going to say, yeah, folks with young kids are also in that category that love the office.
You just have to remember that what happens at the office is not, you know, just people at home making phone calls. It's a lot of mentorship. Right? It's a lot of cultural development for firms who will always be super competitive with each other. You know, and so all that sort of cultural development and mentorship is really critical. And I think it's super far-fetched to believe that offices are not useful anymore. They absolutely have a place and will come back.
Jessica, you make a huge point there because we all went into this, most folks went into this with a company culture that already existed, right? So it wasn't a hard transition to kind of continuing that culture or knowing who are you working with day in, day out. But if you can, and it's not impossible because Zoom and some of these things have definitely closed the gap, but if you can imagine year in, year out, starting a company from scratch and it all being digital and not really having real relationships, I just don't see that being successful long term. So,
well, I'm sure we have some people on this call that are either graduating, you know, this December or graduating next May or in the next couple of years. And, you know, if you get a new job at a new company, but you're asked to work from home, how do you understand what that culture is? How do you learn what the office culture is like? And what's, you know, I learned a lot sitting in the cubes when I could hear senior people all around me in the cubes talking on the phone and meeting with clients. And you just learn a lot through osmosis, I guess, but it's going to be difficult for the students that are on this call and others that are going to it's going to be challenging for them to take a new job and not really understand what that culture is. And how do you get that culture? How do you gain that culture?
So I had a couple of questions come in and they were on my mind as well. One was, so what is all of this being about WeWork, which was really about kind of virus spreading? Let's crowd everybody in a small space together. Is that done for? Has that model been proven that that's not a good model when you have a pandemic, or is that coming back? What do we see in that? And not to pick on WeWork, but there are a number of products like this out there. What's the outlook for that?
You know, I think the industry owes WeWork a great deal of gratitude because they really reimagined the office environment and made it more experiential. I mean, if you've ever been into a WeWork, which I'm sure many of us have, it is cool and it feels good. And it feels like a place to brainstorm and create and even just hunker down and get some work done. You're there with a mission, right? You're with a mission to be productive in whatever profession you use, right? As mainly white collar, professionals. And then it caught on, like the concept caught on of flexible space, right? And amenities, like, amazing amount of amenities to make your experience, at work as fun and as social as possible. WeWork may not have made it regardless of the pandemic, and that's due to mismanagement and just a wildly ambitious, business plan that many of us economically just never understood. But what we owe it to them is their innovation, right? And we copied many of their concepts. And when we think about a hybrid work environment in the future, it probably looks more like some sort of sharing of office space, rather than I have my own corner office or, big divided space. It's like, I might not be there 2 or 3 days out of the week. Why should that sit vacant? There's that hoteling concept that actually is probably going to be more popular in the future. So I think the co-working concept is actually perhaps strengthened once we actually show back up for at the office in the latter half of 21.
I agree with Darren on that. And it's not just the location or the WeWork itself or the co-working space itself. It's the fact that there could be multiple WeWorks or multiple co-working spaces within a city like Denver, where I might live in downtown and want to go to the office that's downtown, but some of my other employees may want to go to an office that's closer to their office or closer to their home in the suburbs. And so there may still be a large office space or a somewhat large office space where the entire office comes in, maybe twice a week, 3 times a week. But then on those other days, you may just go to the co-working space that's nearest your house and work from there. As Jessica said, to be able to get out of your house and away from the screaming kids and the Amazon package deliveries and the dog barking. And so you have a place to go, but you don't have to commute all the way to your downtown office. And so I think that, to Darren's point, there is going to be a hybrid going forward. And I think co-working space will be the net beneficiary of that hybrid going forward.
We totally agree.
Oh, sorry, Paul.
Oh, and I was just going to say, we have a co-working space that we own at the moment, but we're in the process of basically a franchise co-working company is going to take over that lease starting in January, more than likely. And I think they're really excited about, again, might take till April, May, June to really take off. But I think flexibility is everyone's looking for more flexibility. So.
Great. I want to use that as a little bit of a segue, and it goes to a question that came up from the audience too, which was really about the retail sector. And yesterday we learned that the retail sector in Colorado employs 1 out of every 10 workers in the state. So it's significant to the economic support and power of the state. The performance yesterday on the retail side was really reported as mixed, and overall vacancy rising to over 7%, which doesn't sound super high, but negative absorption, and maybe it's simply taking space off the market that keeps the vacancy rate from being higher. So let me lob this over to you, Jess. What's your view of where the retail market is headed, and where are we right now, and where are we going?
Yeah, I mean, the retail market, frankly, has been undergoing some massive shifts for several years. The pandemic completely exacerbated sort of this over-retailed issue where we just have too much square footage across the board of whether it's, the big box stores, the grocery anchor, the smaller boutique. We just have so much retail space. We don't need it all. And I think the pandemic has kind of clearly shown that. Q3 was the quarterly net absorption for retail that we've had in the Denver market in over 10 years, since 2009. So, we've joked a little bit that retail is essentially on a little bit of a diet, right? It's going to be streamlined to more of what is the consumer, reflective of the consumer demand. Certainly, I think the pandemic has shown how much people value, though, the experiential component of retail, be it a restaurant or a show or a gallery or all those types of things, that really sort of mom and pop experience, the curated sort of retail experience, I think is in hot demand and will come roaring back. But, you know, generally, I guess I'd say one more thing about retail is that the pandemic has sort of forced this blending or marriage or interrelationship between industrial and retail, right? Buy online, pick up in store is BOPIS. It's a new acronym maybe for people, but I mean, it has come on, just was so popular, and I think is a long-lasting trend such that retail outlets are not only seen as a retail experience, but also a warehousing experience where you can order it online and pick it up at the store and never set foot in the store. So it's sort of a way for e-commerce to leverage actual retail footprints. So it's a really interesting outlook. It's very mixed. I certainly think we're going to be on a bit of a diet here, but we'll come out with a stronger inventory of retail space, you know, within a year or so.
I agree with Justin. I think it's, again, tale of two cities. It's not just retail as a whole. You can't just say the entire sector is having pain. Sure, the stats might say that, but you look at the restaurant industry, obviously, the Restaurant Association of America has said that as much as 50% of restaurants that are in existence pre-COVID will not exist by the end of this year. 50%. So that's horrible. That's bad that 50% of the restaurants shut down. But when people start going back in droves back to restaurants for the experience and to not have to cook at home anymore, there's 50% less options. And so those 50% that are still open and operating are going to do better than they did pre-COVID. So we were way over retailed pre-COVID. And as we use the term a lot of this whole COVID and pandemic has been a massive accelerator. Any trends that were already going pre-COVID, this has just accelerated those trends. We already talked about it on the office side, on the retail side, same thing. Big box retail was struggling for a while. Now it's even more challenging. So I think, again, it's tale of two cities. It's not, you can't just clump all retail properties into the same category. You have to look individually and look at market by market and location by location to say, is this specific location going to bounce back? Whereas, pre-COVID, it could have been just fine and done just enough money or done just enough revenue to do okay. Maybe we don't need 17 Apple stores in the metro area. Maybe we only need 3 going forward. But so that there's going to be a consolidation and there's going to be less. But the stuff that's left behind, I think it's going to do very well once we start to recover from this pandemic.
I totally agree with both of you. Do you guys see a way to, invest in that? I totally agree that anything experiential, I think people are going to be ready. A lot of types of travel is going to explode. Obviously going into this, if you would have known to invest in Zoom, you would have. So we're sitting here, we know that, or we're pretty confident, right, that experiential is going to be the hit, but not all of us are going to want to start a restaurant in May. So what do you guys think is the best way to take advantage of that?
Well, I think the challenge is going to be if you do have a restaurant that is performing, let's say you're the landlord, you own a retail property and it's got a restaurant in it. If that restaurant is doing well and makes it through, he or she is going to have the pick of any location they want across the city because there's going to be fewer restaurants and some vacant restaurants out there. So it's going to be a challenge to invest in that industry, at least for the short term.
Well, I think you look at both the technology providers and the retailers that are investing heavily. I mean, honestly, e-commerce still has such a long way to go. I mean, I was on the Nordstrom's website, and it's just not the same as walking through Nordstrom's. It has a long way to go to improve to make me totally fulfilled. So that alone won't satisfy me. And likewise, when I walk into a Nordstrom's, I'm often like, God, this store hasn't changed that much in like 40 years. So what this pandemic is going to do is going to force the convergence of what Jessica pointed out, which is this combination, right? Any retailer that is going to thrive going forward needs to both enhance their e-commerce as well as their in-person to give us, the shoppers, right, a multi-channel way to interact with them and to make it as easy as possible to suit our needs. And I, for one, am really excited to go back into do some shopping. I think, that like rubbed off on my mom, who's like a world famous shopper, but like spent a lot of time, cruising through malls and shopping as a kid. And there's something enjoyable about that, even if it's just like something to do with your Saturday, right? Fill in some time in between the sports and all that stuff, and go hang out downtown, or and so I think there's going to be a huge wave of new innovation that happens in retail, and I would look to which technology providers are filling that gap, right? Hang out in the ICSC circles and in Silicon Valley and the e-commerce, tech providers to figure out where that big upside is. We may have missed out on a couple already, with the boom that has happened, but there'll be many more to come.
So Jess, you mentioned this whole, and it was really related to retail and industrial, about this. I guess this wasn't your word, but what I'm hearing is kind of a symbiosis between them. And recently in the news, with Simon and Brookfield, now they're buying up anchor stores so they can fill their own malls, which ironically is kind of a throwback to the 1950s and 60s, when the retailers were the ones who developed the malls. But what really caught my eye was Simon now cutting a deal with Amazon to use some of their mall space as distribution. So maybe you could talk, I mean, come back to retail here, but maybe you could talk a little bit about this tech sector driving and shifting demands to accommodate commerce. I think Rich had a comment yesterday that it's no longer just in time. It's the logistics operation is making sure that you have enough product to when you don't have it coming in. So how does that, because at the end of the day, it's all about reaching consumers. How do you see this? What's going on there?
Yeah. Rich's word was safety stock, which is legitimate.
That's it.
If you back up, look, I'm in my 40s. I haven't lived forever, but I can't think of a time when the industrial supply chain was more of a forefront in like the everyday consumer's minds. And it all started with the run on toilet paper, which goes right to your safety stock comment, Mike. I mean, just in time has been the going theory for the last 30 or 40 years of just have it ready. So you need it. You don't need excess on time. But now that's changed. We also have a vaccine that will hopefully be distributed in mass via extreme cold storage somehow in 2021. That's absolute supply chain. And then of course we've got e-commerce orders. Everybody's frustrated because their holiday shopping is delayed, and people are trying to actually understand why it's taking so long to get it from X warehouse to their home. And then we're going to have returns, right? We're going to return 30% or something like that that's purchased from all these holiday sales, and people are going to have to interact with that new supply chain again. And to Darren's point, a lot of them are going to go to the actual store and return it, as opposed to going via FedEx or the mail. I mean, it's just really interesting to sort of see this shift in the supply chain, and it's really driven, I think, a lot by e-commerce.
I know you're an expert on industrial and the marriage between these two. I did cite a recent survey by Prologis and CBRE. They said that every additional $1 billion of e-commerce sales results in a net increase in industrial demand of about 1.5 million square feet. Well, that is very applicable to what we just experienced in 2020, because the forecast for e-commerce sales is about 12% annually increases. It's been happening for a while, and it's forecast to happen in the future. Well, we went up about 30% just in April and May. So this is like huge 3x leap. It equated to an additional $1 billion in e-commerce sales just in Q2 of 2020, which then relates to an extra 1.5 million square feet of industrial demand on a national basis. And so, we're looking for ground up development opportunities in the industrial space, both like larger, warehouses, as well as like last mile distribution centers, around growing markets. But just wanted to connect some of those dots about why the marriage between retail and industrial is so important, in this case, e-commerce and industrial.
It's a great, thanks for quoting that study. It's 125 million square feet, so just even a tiny bit more, Darren, but yeah. It's a great study. Two other things I'd say. Amazon increased its warehouse square footage by 50% this year. And to bring that home to Colorado, Amazon has more than doubled its number of logistical outposts across the state, be it build to suit or lease. Some of them aren't done yet, but I mean, they are absolutely rolling out their footprint, but they're catching up to the likes of Walmart. And Mike, back to what you were saying with what they're doing with Simon and the malls, Amazon is still catching up to actually have square footage and a footprint to reach consumers compared to Walmart and the malls. And so it's almost like two different ways to get to consumers. What's the most efficient? Don't forget about returns, because that's a really difficult process everybody has to go through. And I think that's really kind of crucial actually to how these e-commerce supply chains roll out.
We've talked a lot about the consumer side of it, the retail, e-commerce, and how that has impacted industrial. I think there's another significant trend that's occurring, which is companies are saying, I need to have more of my manufacturing occur in the United States and not occur in China or India or Mexico City. Not all of it. They're not moving it all. They're not onshoring all of their manufacturing, but there are certain critical components and certain products that they say, well, we need to have that made here in the United States. So that's increasing the demand for manufacturing space. But it's also increasing the demand, and maybe Rich talked about this yesterday. Sorry, I missed part of his presentation yesterday. But when COVID hit, companies couldn't sell product to consumers because they couldn't get it out of China or get it out of India or wherever it was being manufactured. And so they were losing sales significantly because they didn't have enough stock. They didn't have enough product. And it's not just toilet paper and retail. It's car manufacturers were not able to build cars because they couldn't get the components to go build the car, to go sell the car to the consumer. So I think we're going to see an increase of inventory for large, like manufacturers of computers, manufacturers of cars, manufacturer of large product that need to just store more of their individual components onshore in the United States. And that's going to increase the demand and the desire for more industrial space in the US as well.
The other significant shift in regard to industrial and online shopping is, I guess, thank goodness from a city's perspective that they now charge sales tax on all of those sales. Without that, the budgets would be even worse than they already are. But I think that, with that shift was probably essential, and I think that happened in 2018. So if that hadn't happened by now, I think it would be a totally different story right now.
Yeah. So Paul, in addition to sales tax revenue, Chad, I totally come back to your point on the manufacturing side. Rich made the point yesterday when they were looking at state job numbers that manufacturing was one of the relatively best sectors in terms of retaining those jobs and for anticipated recovery. I think that's totally true. And I think hopefully it, one of my kind of quips these days is industrial just having its moment, and I really don't think it is a moment. I think it's a much longer term shift to reassessing the value of that real estate sector, whether it's bringing in sales tax from this interwoven retail relationship, whether it's manufacturing jobs that actually allow us to get goods and wholesale parts and all those types of things to different groups. I really think industrial just has stepped up its importance maybe in the everyday kind of consumer and economy mind.
Well, and I totally agree with that, Jessica. There's, like the retail industry is going through a burst of problems and challenges, and some of them will get solved, some won't. Office is going through the challenges we talked. Industrial, I think, is actually, it's in its golden age, and this is a fundamental paradigm shift in industrial long term. This isn't just a blip of how this is going to impact industrial for the next couple of years, like all of the other product sectors have had just a blip in the market. Industrial, I think this is a long-term paradigm shift of the use and the need for more industrial space.
Yeah, that's right. And it's showing up in the valuations, right? As pricing discovery happens, as transactions have come back slowly this year, and they're still down, 40% over what they were in 2019. But we've seen industrial prices nationwide increase 7%. So we talk about the K-shaped recovery. Industrial's way up here, And retail is at the bottom of the K. Retail prices nationwide are down 5.2%. So, and those statistics come out just yesterday from RCA. And so I was studying some of this research last night, and in between that K-shaped recovery with industrial at the top, right? Net beneficiary, major beneficiary, as everyone's making the point here, with retail sort of like lagging behind big time, although there'll still be great opportunities there. Then you have multifamily, which is also up net in terms of pricing. Office is about flat, hotels are down as well. So we truly have a bifurcated market in the investment real estate world right now, with industrial and retail being the two most extreme cases.
And Darren, you point out that hotels down, and I want to get to hotels because I think a lot of it was made of the hospitality industry and the importance of it in Colorado. But you're seeing pricing continue down, and forecasting continued declines in hotel prices and pricing in the industry?
Yeah, obviously hotels have been just brutal because while offices typically have 5-year leases, 10-year leases, you have that locked in through longer term lease agreements with corporations that are paying their rent even though nobody's in there, right? The hotel industry obviously has a nightly lease. That's the way we think about, people who stay in hotels. And that just evaporated overnight. Went in some cases went to 5%, 0. We've seen hotels shut down. We think that this is, a lot of hotels are failing and will continue to fail because, unfortunately, this is being extended, until mid next year, where those of us who want to travel feel very safe. The return of business travel is going to be absolutely critical to hotel, income. So we've got an income problem, with all sorts of real estate right now, but hotels are really a critical piece of it. Because without income, it's hard to figure out what your cap rate is. You're down to the price per square foot valuations, and eventually, we just have an income problem, which relates to a debt service problem. So we've seen a spike with workouts, right, where loans are defaulting. They're going back to workouts. The first step is a workout, and if there's no workout possibility, then that results in distressed asset sales. And hotels and retail, but hotels specifically have spiked dramatically this year. And unless we all get back to staying in hotels pretty quickly, we are going to see those current workouts result in distressed sales. Now, the question is, what do you do with some of these hotels? Some of them are just dead. They maybe should have never been built, or they're in a place where nobody wants to stay anymore. There's just less demand for hotels, which again will result in, some of the existing hotels in quality locations to be the net beneficiaries of that midterm. But it's kind of interesting to see some of them be repurposed, right, to multifamily or workforce housing, solving some more ESG needs, environmentally social governance type needs with regard to workforce housing. You've seen some hotels transition into temporary homeless shelters, right? So it is interesting when you get creative about that shouldn't be a residence inn anymore or an Embassy Suites anymore. What should it be in the future?
Chad, you have a few hotels.
Yeah, so we have one in Boulder. I know this is a somewhat national and statewide audience, but we do have a hotel in Boulder, and it's an extended stay suites. It's Homewood Suites, but it's extended stay. And we actually dipped down, right at the beginning of the pandemic, we dipped down even sub 20% occupancy for a few days, a few weeks even. And then now we're back up to that 60 to 70% occupancy again. But it's again, I'm going to go back to the tale of two cities. If you're a business focused hotel where you cater to business executives who are traveling for sales or traveling for meeting with clients, whatever it is, you're still down. You have not seen hardly any recovery. In fact, many of those hotels are still closed. They closed down early in the pandemic and have remained closed. Same with conference center hotels. I mean, have any of us been to a conference? No, we're doing it all virtually via Zoom, and that's going to stay for a while, at least until the vaccine is fully distributed and people are comfortable going back. But I think going forward, there's still going to be a hybrid, or even potentially for a couple of years, there could still be these Zoom conferences just for the overabundance of safety and trying to protect your employees from getting into large gatherings. So if you're a hotel that focuses on business travel or business conferences, you're either still closed or you're really struggling. And you look at a hotel like the Gaylord Hotel out by the airport by DIA. We own 133 acres directly next to that, right next to that hotel. They're still struggling to try to figure out how to reinvent themselves. They're trying to figure out how do we attract the leisure travel. Now, that's the other side of the tale of two cities, which is leisure travel, is people are starting to travel again, leisure. They are starting to get back out there, and they're still social distancing. But we had a client come in the other day, and he spent $26 round trip for an airline ticket from LA to Denver. $26 on United Airlines, of all places too, which just, okay, well, if it's that cheap to travel, people are going to start taking a little more risks. But I still don't think the business traveler and the conference center travel is going to come back for at least 2021, end of 2021, 2022. Some people are even predicting 2023 before we see that business back to pre-COVID numbers. Whereas business or leisure travel, vacations and things of that nature is already starting to show signs of recovery. So again, tale of two cities, not just the whole hotel industry is in the tank. It depends on the location and the product that you're offering and the service you're offering that differentiates whether or not that hotel is going to do okay and survive, or whether they're going to go, as Darren said, in through a workout or through a foreclosure.
The other industry that's obviously benefited from this is the Airbnb sector. We've got at least the Airbnb sector in certain destinations. We've got 25 of our homes at Summit Sky Ranch that are part of a rental pool, and we've outperformed revenues by $300,000 throughout this year. I mean, it's just, and I think we'll be at 30 homes under that will be part of the program by the end of this year, and probably 40 into next year. So I mean, it's been amazing to see kind of and they're booked most of the winter. Obviously, now that they changed they went to level red and things, I think there's been some jostling of reservations, but it's been, when it first started, of course, it happened to be at the end of March. So April, May is normally slow anyway. So, and we were hoping to get going again in June, but it just exploded in June. I mean, it was unreal. So,
well, to that point, so I know Hawaii just recently announced, and I know other states and other cities are doing this as well, but Hawaii just announced that if you travel to Hawaii for a month, they will pay for your airfare round trip. And so you typically, you're going to a market like Hawaii, or if you go to Jackson Hole, or if you go to Vail or wherever, you usually go for a week. So you want to stay in a hotel. But if you're going to go for a month, I think more people are going to try to look for Airbnb options if you're going to stay there for a full month. And I know there's other states and other cities that are offering that same incentive to try to get that leisure traveler, that vacation traveler to come back into their market, because their economy is so, especially Hawaii, is so heavily dependent on that leisure traveler. So they're offering free airfare if you take a month to go to Hawaii. It's a great deal.
That's amazing to hear, because if anyone had planned a Hawaiian trip up until just recently, they had to cancel it. I mean, basically Hawaii was not allowing, mainlanders or outsiders into Hawaii. I know people who had to cancel their trips. And so to have them reverse that, because I think what they were seeing, they were actually seeing Hawaiians leave because of the lack of economic opportunities there. And that was, something that I think really caused them to say, okay, what's the worst damage here? The lesser of two evils, right? Like allow tourism to resume, and allow people to come visit Hawaii, or lose the Hawaiians and to the mainland because they just couldn't afford to stay at their own home state any longer. I think it's, we've never, ever seen a collapse of business fundamentals like we have experienced the last 9 months globally in the hotel industry. It has never, ever happened. 9/11 wasn't even close, right? And so nobody has showed me like a comparable event, on a global basis where hotels, occupancy dropped the way that they have. This is a once in a, 500-year type of experience, way more than once in a generation. I guess to the investors out there, think about, if you see opportunities out there, do you believe that we will return to traveling? That we are a wanderlust species, and we want to get out there and explore, or we have to because we want to visit friends, family, or do business. I think the hotel industry the disruption is incredibly exciting, although painful for very many, and we need to be sensitive around that.
Yeah, usually those industries that take the biggest dip down are the ones that have the most to recover, right? So I agree with you, Darren. I think there's potential huge opportunities over the next 2 or 3 years in the hospitality industry to pick up some pretty cheap hotels that you just need to be patient before they can come back and start generating net income again.
Well, I'm going to ask you to hold those thoughts here. so that you, because towards the end, I want you to tell me what you think is, and tell the audience, what's the deal of the century for you with your own money. So I want to shift over to residential, and then I didn't mean to cut you off, Jess. We can come back, but I want to make sure that we talked a bit about residential, because that was something of a wild card yesterday and is a driver for the Colorado economy. And the question that keeps coming back is, are people really fleeing from Denver and moving up into the mountains? And are they making that a permanent move, or is this just to get away from the situation? Is there really a migration? There was a report from My Move a couple of weeks ago. It said 16 million people have fled large cities during the pandemic, with 14.2 million of those 16 filing a permanent change of address form. And this has never happened before. So Paul, you're on both sides of that. You got one foot in the city and one foot in the mountains. Are you seeing this? What's really going on there? Are we seeing a flight? An urban, suburban, rural flight?
Yeah, no, I think we're seeing both a coastal flight and then a urban to suburban or urban to more rural settings for sure. We at Summit Sky Ranch, we would typically sell about 35 homes a year. And we'd only had about 5 or so sales when the pandemic hit. But starting from June 1 through the end of the year, we're now at 60 sales. So normal year 35, this year is going to be 60 sales, and the pricing is even up. I mean, it's been, and then like I said, the Airbnb on that side has also been kind of shocking. So what it was interesting, I was looking at some statistics yesterday, and home ownership rate in our country went from 65.3% in Q1 of 2020 to 67.9 in one quarter. And I broke it down to even the people that are below 35, and it went from 37.3% to 40.6%. And I think what you're seeing is the acceleration that Chad pointed out is you had all these millennials, it's the 70 million population, and a lot of them had wanted to potentially move finally to a house and whatnot. And with the interest rates dropping like they were in the pandemic, I think, and we've seen this in some of our apartments in Denver, where we've got more month-to-month leases going because they're waiting for their homes to close. And I think that's, millennials are now on the high end, it's 24 to 39. And so a lot of those, especially in the 30s, are people that traditionally would have in the past been in a home already. And I think a lot of them have made that shift. So I think it's temporarily created this increased vacancy in the multifamily sector. The good news, countrywide, and especially the places that are attracted to younger populations, and I think this maybe speaks to, is the city going to come back? We've got the next generation is just the same size as millennials. They're 23 years old is on the high end. And so I think you have got a gap here that's been created by this acceleration. But I think we've got a population that's just as big, and Denver's still just as attractive to young folks. And I think that'll come and refill that gap year in and year out. It's going to take a few years just because of that acceleration.
Well, I'd say on top of that too, it's not just the demographic. I completely agree with everything Paul said. It's also just, again, a paradigm shift of where do I want my primary residence and where do I want to spend most of my time with my kids? And it used to be you have a 1 or 2 bedroom condo in the mountains and you got a 5 bedroom house down in Denver. That mentality has shifted. We're actually partners with Paul on we own Frost Creek up here outside of Eagle. And we're partners with him on building some spec homes. And we're seeing that fundamental shift of people saying, I don't want a 1 or 2 bedroom condo in the mountains. I want a house in the mountains. So that if I have to go put my family and my kids and everybody for 2-3 months at a time, I want to make sure that I've got the room to spread out. And they're shifting their mentality of what a secondary home looks like. In addition to that, we're seeing a lot of people, I know you are too at Summit Sky Ranch, Paul, we're seeing a lot of people that are just giving up their houses in the cities and the urban areas, and they're moving to the mountains because they are realizing how easy it is to work from home and how they can get most of their work done from a mountain town house, or where, you're seeing it in Napa, you're seeing it in Jackson Hole, you're seeing it in, beach communities all over the country. People are realizing that I can do a lot of my work from home. And I want that home, instead of it being in New York or Chicago or downtown Houston, I want that home to be, with a little more space, a little bigger house, not quite as, maybe not as close to the amenities, maybe not as close to sporting events, but still able to get to those places like the mountains of Colorado. You can still go see sporting events. Well, once they come back, you can still go see sporting events, for an hour and a half drive. And that's okay, as opposed to being located right next to, the sporting events and then spending your weekends in the mountains. That's actually kind of flip-flopped to more people wanting to spend most of their time in the mountains. And we're seeing, like I said, here at Frost Creek, we're seeing just a huge demand of people that want to have either second homes or their primary homes that are moving out of major cities across the U.S.
So how much of that is, if any, due to the sense of urban turmoil, riots, homelessness? There was an expression about the perception of renewed urban blight in Denver with the growing homeless population so visible. How much of, two questions really, and thank you to the audience for one of these questions. How much of the move out of Denver's urban area is driven by that? I don't know how you measure that, but how much is driven by that? And then what is the solution? What is the solution to, if you will, the homeless problem in Denver, other cities across the country too?
Well, if we could solve the homeless problem on this call, that'd be phenomenal. But
well, I'm thinking you and Paul might. So I was just going to put it out
it's a
there.
combination of factors, and to your point, Mike, it's pretty difficult to put percentages to any one factor of what's moving people out of urban areas. But restaurants in downtown Denver and other major metropolitan areas are not as open as they used to be, or not open at all. Movie theaters, sporting events, all the reasons that people want to live in an urban area. And when I say urban, I mean the Denver core or New York core or LA core, not the entire metropolitan area of Denver. But people are they're losing the sense of safety, whether it's homeless or whether it's increase in crime. In fact, I just met with a prospective member up here at Frost Creek. He's one of the district chiefs for the city of Denver. He said, crime of vehicles stolen are extremely, in neighborhoods like Hilltop and Wash Park, vehicles being stolen are up like 40-50% year over year. So it's crime, it's safety, it's the pandemic from a safety standpoint, meaning you don't want to be so close to other people and so congested. It's the safety of, like I just described, the homeless and crime being increasing. And then you add on top of that it's just not as appealing. You don't go out to the bars and restaurants and go to a movie theater, go see a sporting event as much as you used to. So the appeal of living in a corridor or in a downtown core like that is losing its luster as well. How do you solve it? You got to reverse all of those trends. You got to get cool restaurants open again. You got to get experiential retail. You have to figure out how to get those sporting events going again. You got to get, the Mission Ballroom back open again and having concerts. You got to create all of that stuff has to come back in order to create that attractant that says, okay, now I want to move into a downtown area again.
But I think hopefully when you reverse all those things, you also create more opportunity. Hopefully with more opportunity, there are fewer homeless. I also think, Denver, with them recently passing to be, creating a permanent funding mechanism, that was projected to be $40 million a year, will probably be less here, at least in the initial years. I think getting permanent supportive housing to it was 600 or so that were living on the street. There's like 5,000 or 6,000 total homeless, but it's about 600 that were on the street. I think that grew to about 1,000 during this pandemic. So hopefully by not having a pandemic, it goes back at least to the 600. And then hopefully with the funding, that creating permanent supportive housing, hopefully we can get that to even drop even further. So I think that's, we've got to have a economically vibrant city, and I think it hopefully, at least pushes that in the right direction. So.
Yeah. Hey, I just wanted to broaden this conversation though a little bit, just from, Denver and the mountains, because one of the really interesting facts I learned yesterday in Rich's panel was the sharpest home price appreciation for single family homes was in Pueblo and Colorado Springs. And, whether or not you're talking about demographic shifts and millennials ready to settle down and get a home because they can afford it, or pandemic related moves, it's really, Colorado has a lot to benefit, I think, outside of the Denver core, because it's largely a suburban state, or rural. but there's just, with Denver being the most urban market, I just want to broaden the conversation to some of the benefits that Colorado Springs and Northern Colorado and Pueblo and Grand Junction and the mountains will see from increased moves. The other comment, just playing demographer, has to do with the fact that we're aging quite a bit as a state. And generally speaking, a lot of those folks end up moving to non-urban areas as well because they want to be close to their kids who've got families, or that's where the retirement communities are and such. So there's just a lot of tailwinds, I think, that go to suburban development, maybe that helps retail development and office development and occupancies in those markets.
That's a great point, Jessica. I think to that point, the fact that U.S. News and World Report ranked Colorado, 4 cities in the state of Colorado were ranked in the top 5 nationwide. Boulder #1, Denver #2, and I don't remember if it was Colorado Springs, then Fort Collins, or Fort Collins, then Colorado Springs, but 4 of the top 5 cities in the country to live and to work and to play are in the state of Colorado. So you make a great point that it's not just Denver and it's not just the Denver metro area. It's the entire state that people want to come and live because we check all those boxes of lifestyle and opportunities for job and highly educated workforce and all the other reasons that people want to live in Colorado. It's not just people moving to the Denver metro area. It's people moving to this state.
Right. Which goes, Darren, to, this is the other point I wanted to get on the hospitality side, is that we'd be remiss not to mention that Colorado is so lucky to have such a huge leisure and hospitality market. Summer, winter, spring, fall. I mean, not all states can say that they actually have that many arrows in their quiver from a comeback standpoint on the hotel side.
So true. I'll leak a little bit of my information about the end, but if I were to make a fun investment in Colorado, it'd probably be a hotel in Aspen that I'm not going to steal it right now. Like, I just might have the opportunity to buy it at a reasonable price during a pandemic, so that would be maybe Telluride or some of the cooler mountain towns that I've lived in and had a blast in the past. So I agree. If we're on multifamily and housing in general, just the residential sector, it's worth noting that, behind industrial, when you look at Green Street and some other research that's out there where the forecast for like the highest return, net operating income growth and the highest return to investors, we love single family residential for rent, right? Single family for rent is a niche of the residential market. It's basically picture your neighborhood, out there somewhere between Boulder and Colorado Springs, right, in the suburban market. And all of those residential houses, single family, are available for rent. And whether you put it in the Airbnb pool like Paul does, or you just rent them out like on a monthly or annual basis, that is a huge market because even though rates are really low, historically low, pricing is incredibly high. And many of us have become renters by necessity, but we want the small yard, for the kids and the dog to run around, right? And we want it to be nice. It's probably outside of many of our reach to purchase, even if I can get 3% interest rate on a loan. It's just gotten crazy expensive, and I don't know if that's going to stop. So there's going to be a huge demand for single family rental, and we love those projects. We're looking actively for those projects. It's a booming market, as well as manufactured housing. For the retirees out there, there's a boom going on in the manufactured housing and even the RV park space. So little niche areas of residential, beyond, just the single family sales and apartments in big apartment buildings. Those are interesting sectors, and we are paying at CrowdStreet very close attention to them.
That's kind of a segue to, I want to make sure we touch upon public policy. We had the election, national, state, local. And I think when we last chatted, there was a lot of consternation about what does this mean for the real estate industry, if anything. So the question really is, what's the biggest threat from a public policy standpoint that our industry faces? And maybe, Jess, we can start with you on that from a big picture, and then feel free to drill down.
Oh, lucky me.
Yeah, so many.
I suppose two things come to mind on a very long list of ways to improve our sector. Number one, I'd say honestly is ensuring that the downtowns can maintain a sense of safety and vibrancy. As we were talking about with all the folks struggling with homelessness and how this K-shaped recovery is only going to exacerbate that divergence. You know, I really do think the downtowns, be it Boulder, Denver, Fort Collins, all across the country, really need to be front and center in our minds. They are critical to, you know, that urban sense of living, lots of jobs. It can be an affordable way of living for many folks. And then the last thing I'd say is really ESG, the whole sort of environmental, sustainable, social governance, those kinds of things are working its way more and more into our sector. You know, save for more regulations and things like that, which nobody wants. I do think it will bring longer term, better, more holistic investment decisions to our sector. So it's a long list. I could probably talk about it for 10 hours or something like that, but I'm trying to jam a lot of thoughts there into a 30-second response and then pass that hot potato off.
Yeah. Well, some of the things, just to sprinkle some of the thoughts that have both come in questions, and thank you. And I'm trying to work your questions from the audience into our commentary this afternoon. Question about possible rent control, affordable housing mandates. There was a question about the 1031 exchange rules going away. What would that mean? Even a question about the pandemic risk insurance in a possible stimulus package. And then this last one that came in, the question about, you know, does this mean sustainability is taking a pause? And we've just thrown the environment out because of the pandemic. And is that going to come back? And if so, is that going to help us or hurt us? So those were a few kind of broad questions. And there was also a question about, will the Gallagher Amendment help or change communities and or the real estate industry? So why don't we get your reactions to some of these federal rules, the income tax rules, the 1031 exchange rules, and also the opportunity zones, as to kind of get a reaction to that first. And then let's switch over to more local and hit rent control in Gallagher.
I'll touch on the taxes real quickly, which is, I think there's, regardless of which party took over the White House or takes over the White House, I guess there's still some people that question as to who's going to take over the White House, but regardless of which party it is, and regardless of which party wins the Senate, there's got to be an increase in taxes at some point in our future to cover the $4.5 trillion that we've already spent and another $2 to $3 trillion that's still to come in stimulus. There's only so many ways to pay that back. And one is through increasing taxes, and others through inflating ourselves out of it and, you know, inflating the US dollar. Either way, it should impact people like me and Darren and those that invest in Paul, who invest in commercial real estate and residential real estate. We have to make those decisions to know whether or not by taking capital gains taxes today or ordinary income taxes today, how is that going to be compared to taking capital gains in the future or ordinary income in the future? Because both are set to go up, and there's high probability, in my opinion, that they are going to go up, either capital gains or ordinary income or both. So we need to start, as real estate investors, we need to start thinking about that and start making decisions based on how that's going to impact the net income to us after tax income. Then you add on top of that the fact that there's been, you know, discussions that the Biden administration about removing or changing the 1031 rules. Whether or not that happens, I'm not here to opine on that, but there's a chance that the 1031 exchange rules could go away, and that starts to impact people's decisions as well as to whether or not to trade out of their property now or whether to just hold on to it for a much longer period of time because you don't want to pay the government taxes. You just want to, you know, hold on to that property longer. So all of these things are going to have an impact, and in my opinion, it's still yet to be seen as to how those things are going to impact decisions going forward. I think right now everybody's still trying to figure out, you know, like we've talked about, retail, office, industrial, how's it going to make it through this pandemic? But when you start to look longer term, you have to start taking in taxes into consideration, and we and our investors are heavily looking into that to see what do we think we should be doing today based on higher taxes in the future.
Yeah, Chad, that's a good point. And we don't do a lot of 1031 exchanges, so I'll let the other panelists address that. But we do a lot of opportunity zone deals. And the question is, was that a good program, and will it be attractive in the future? And no government program like this is perfect, right? And we could definitely poke holes in it and find the flaws. But the truth is that the attempt was to get investment dollars into underprivileged communities that could use and benefit from those investment dollars. And it has benefited. Right? There's tons of examples, dozens, hundreds of examples where development is happening and gentrification is occurring. Jobs are being created in communities that were identified as by the governors of these states as opportunity zones. And we are seeing a surge at the end of the year because of tax planning and because of the continued popularity of the opportunity zones. And the tax advantages are really compelling. I mean, you get to defer for 7 years your capital gains payment, and then if you hold on to a project for 10 years, you get to completely eliminate the tax burden that would happen in the new investment. So it's complicated. Talk to your tax advisor, but if you are looking to defer or eliminate capital gains rates because you think that might be going up in the future, definitely the opportunity zone is something that you should be looking at. And so we've got 3 different deals coming out in the month of December for opportunity that are structured as opportunity zone investments. And some of them are with major sponsors, right? So it's good, you can look at sponsor quality. Are they going to be around 10 years from now? You look at the project, right? And, is it a viable project, of course, right? And you look at the investment structure. Those are the 3 main sort of high level things that you look at and sponsor, in this case, with an opportunity zone, because it's a 10-year holding, you really have to put extra emphasis on the sponsor quality, right? That you don't want them to mismanage or blow your tax your tax protection. That the reason why you're going into an opportunity zone deal. So I think it's pretty good.
One counter that I would say to that, and I agree with you, Darren, but the counter is just maybe a devil's advocate, I would say, is that, for me and for everything that we do, it's all about location, location, location. And we want to make sure that the real estate that we're buying is great real estate today. It's going to be great real estate 10 years, 20 years, 50 years from now. Even if we don't plan on holding it for 50 years, we want to know that the real estate we're buying or developing is always going to be in favor and is always going to be a great location. And generally speaking, not totally, but generally speaking, opportunity zones were not prime main streets in urban areas or in great growth locations. Generally speaking, the opportunity zones were in kind of the next tier of real estate. So again, not saying that there aren't great opportunities in opportunity zones, and we've seen plenty, and I know you've done several, Darren, and there's some great ones out there. Just be cautious. Don't do the deal simply because it's in an opportunity zone. Make sure it meets all the other factors that Darren said, and I would say as well, make sure it's a great location. Then if it's an opportunity zone, that's the icing on the cake. That's the benefit that Darren just talked about.
Correct.
So let's go local a bit, and I'm looking at, you can't tell it, but I'm looking at you, Jessica, because I'm a fellow member of the National Association of Business Economists, and when we think about property values, it's tied to public goods and services, which is tied to taxes, and we've just had some very interesting changes in the state of Colorado that will impact municipalities' ability to fund and to finance and tax. So I bring it back to you. I gave you hopefully a minute to kind of think about this, but what is the Gallagher Amendment change? What does all of that mean now for our local communities and then for our local real estate?
From a business owner and a tenant perspective, the Gallagher passage is good news because it reduces a lot of the just downside uncertainty that particularly industrial tenants and triple net tenants had to pay. They're responsible for directly paying those property taxes, and they have been skyrocketing year over year to almost absurd amounts that make renting space, leasing space difficult. Usually, taxes and other triple net expenses are something that you just sort of, okay, I'll take care of it. It's not a big deal. But it had to zero in and make business decisions around how much their taxes are going to go up in the next 2 years and whether or not they can afford to make an investment in capital or labor, et cetera. And so I think it's a great step forward in giving those business owners some certainty and ability to at least project that they can't go that much higher than they have in the last couple of years. I also think it's really good news for the smaller communities. It just allows development, I think, to happen. It allows those communities to fund services, be it libraries and police and et cetera, in just a much more sustainable, predictable way. And, Chad and Paul are probably much better to say this than I am, but businesses thrive in times of certainty when the rules of the game is much more known. And so I think removing some of that uncertainty is positive for the state of Colorado.
I agree, Jessica. I think, for those of you that aren't familiar with the Gallagher Amendment, it basically set the percentage of taxes, of tax revenue on properties coming from residential versus the percentage that comes from commercial. And it was passed in 1982 and just now appealed and removed in this most recent election. But I think I'm sure it had good intents when they passed it. I'm sure there was a good reason for it, but it just got so out of whack. And then the Tabor Amendment came on board and it just complicated things even more. And to Jessica's point, it just made commercial property taxes go through the roof over especially the last 3 or 4 or 5 years. And it was no longer a balanced approach to property taxes and to the income and the revenue that the state of Colorado and the municipalities or the counties and municipalities are able to use. So I think bringing it back in balance because we had so much residential growth and yet it was still only 45% of the taxes. And it didn't matter how many houses you built, it was still just 45% of the taxes. And so commercial just kept getting hit harder and harder and harder. So whether you're a landlord passing through your taxes to the tenant, it impacts the tenant's ability to operate. Therefore, it impacts the landlord. Or whether you're maybe on a gross lease as an office landlord or other type of landlord where you're not passing through those. I know most of Colorado now has switched over to triple net leases, but even if you're not a triple net on a triple net lease, then the landlord has to pay that, which then obviously just increases the rent that they charge to their businesses and to the tenants. So I think there's a reason it was a bipartisan effort to repeal the Gallagher Amendment, and there was a reason I think 76% passed it because it wasn't working anymore. So that should be a net positive for businesses in Colorado going forward.
Paul, how about rent control? How do you feel about that? Residential rent control.
Yeah, so for those that, because the legislature got paused and then restarted because of COVID, they didn't really get around to the inclusionary housing ordinance that currently doesn't allow at the state level. You really can't add inclusionary housing on multifamily. And
what is inclusionary housing? I'm sorry, just tell us what inclusionary housing is.
Housing can be pretty broad. So it can be that if you're going to do a multifamily project, can the municipality require a certain percentage of that to be affordable? But it also can include rent control. And a lot of folks think that the legislature will probably take up that issue in this next session that's starting in January. And it obviously would have significant impacts. I also think that hopefully we as a state in Colorado can learn from the places that actually have, passed rent control. There's been a whole bunch of research done. It's a net benefit to the folks that actually get lucky and get one of those units, but it's been shown to not only decrease potential supply of additional housing in the future, so that often increases the cost of housing, but it also is everyone else that didn't get one of the rent controlled units is kind of left out. And so but with that said, on the inclusionary housing side, I know in the city of Denver, it'd be nice to get some. Right now, if you're going through a rezoning, there's kind of this impromptu rule that you need around 10 to 15% of the housing to be affordable, but it's actually illegal for a city to require it currently because they haven't changed this at the state legislature. So there's a whole bunch of developers and folks that are trying to get different properties rezoned, and there's this current uncertainty that I think is clogging the system. And so as we talked about earlier, if it is passed at the state and the cities can get clear on what their expectations are, then that provides expectations that are clear to developers. The net loser in that situation is the landowner. Because if their land at CMX 5 zoning would have produced X amount, now it's CMX 5 zoning, but 15% of the units are affordable. Obviously, as a society, I think affordable housing, mixed income housing throughout a city is great planning, and it makes a lot of sense. And so, but like I said, with this inclusionary housing change, it could come in the form of rent control. It could come in the form of when you apply for developments, percentage of your units. So I think it's really important for the industry as a whole to stay on top of that and to stay connected and stay involved, and make sure that what we've learned in the past from other states, we don't repeat. And as a society, obviously, we try to attack this affordable housing problem in the smartest way possible. So.
Well, and there's a strong component of the population, especially in the Denver metro area, that wants no growth. They're trying to slow growth or create no growth initiatives because of traffic and because of just the density that has occurred. But that then just creates, because the demand for housing in Denver is continuing to go up. There's more and more people that want to move to Colorado. So by creating these no growth initiatives, you're actually saying we're going to limit the supply. But the demand is still growing. So therefore, the pricing of housing continues to go up, as we have seen. And as Rich talked about yesterday, it's continuing to go up, which makes it more and more difficult to create affordable housing. And to create housing, it's not just affordable with a capital A, it's obtainable housing. It's the housing that just the average worker can come in with a median income, can come in and afford to buy a house or rent an apartment. The less supply we have, the less, or the higher and the demand isn't changing, then the higher the pricing is going to go across the board, whether it's apartments or for sale. It's just going to continue to grow. So we have to solve, as Paul said, it's a massive issue. It's not one that we're going to solve on this problem or on this call, but you can't limit supply and then expect to also at the same time say we're going to solve this affordable housing problem. They go hand in hand.
One of the questions that came in from our audience, and thank you, is, I'll read what was written. Isn't single family rental investment killing the opportunity for single family ownership, especially large residential investment firms buying thousands of units? Isn't that killing the opportunity for single family home ownership?
I'd have to see the data behind that. It's one could imagine that if Blackstone is buying up huge portions and thousands of homes in the Front Range of Colorado, then to put them in the rental pool, then that's fewer units to just be on the open market for sale. So I see the question's point. I just don't know. I haven't seen any data that's actually having an impact. It could be, and it is fueling the demand for new housing and construction and that whole entire industry. So it's creating jobs. And as we all know, people, whether you're from East Coast, West Coast, North or South, Colorado is super attractive and will continue to draw in new migrations or new inhabitants. And that's one of my, to where I would want to invest. I would want to invest in single family residential development in my world between Denver and Boulder, because I know how attractive that corridor is. And I think that's, going to continue to drive demand from renters for the rest of my life. So that's a place where I would put some money.
Good. Well, we have a few minutes left. So let me, Darren, you've spent all your money, I think. Let me ask the rest of you, kind of hearing what you've heard. So the question is, where would you invest your money in real estate? And I think, Darren, you answered it as was the spirit of the question. Not where would you tell clients to invest based on their profile. It's really asking you guys,
right? Yeah,
not giving advice. Where would you invest today?
For my own dollars. That's right. That's something I would look very, very seriously at.
Okay, so I got you for the single family and also a hotel somewhere in Aspen for a good price.
Yeah, and he's going to let us all stay there for free, right?
That's right. Uh-huh.
So to that same point, I would say we're closing on two properties here in the next call it before the end of the year, so less than 30 days. One is along that corridor that Darren just said between Boulder and Denver. We're buying the old Storage Tech campus that ConocoPhillips back in 2008, 475 acres for a future development of commercial office, potentially some retail. And there's a desire from some community members to build residential there as well, but it's currently not zoned for residential, and there's a lot of pushback about having any additional residential in the city of Louisville. So right now it's all for commercial that we'll develop. But the other project that we're closing on here in the next week is some land in Erie, Colorado, so kind of in between Boulder and Fort Collins, in between Boulder and Denver, for 53 single family homes. So again, residential land. I'd just also like to add on the land side is it's a potential, and it is a very good inflation hedge. And I think with the amount of money and the amount of stimulus money that has been pumped into our economy, not just in the United States, but globally, there's a high probability we're going to see inflation over the next 5 years. And so land is a great inflation hedge, as well as gold and Bitcoin and other investments. But that's another reason why we're pretty bullish and bold on buying land right now.
And that's your that's obviously what your firm is doing, but is that also where you're putting your money? That's
so we're always the largest individual investor in every project we buy. We're always the largest individual investor. So in this case, yes, in both these cases, we are putting my personal money and my business partner, Jeff Baukol, his money is going into these assets. Yeah, that's where we would put our personal money. And then separately, I would say completely unrelated to real estate, Bitcoin. I'm putting a lot of money into Bitcoin. That's a whole other topic.
Oh, that's good. Okay. Jess, how about you?
Yeah, I specialize in industrial, and so I'm definitely drinking the Kool-Aid. I really believe in the long-term macro trends that we've talked about there, whether it's e-commerce, which certainly gets all the attention, but manufacturing, life sciences, technology. There's just a lot of new sort of drivers that are gobbling up industrial space. So I would put my personal money, and I do, in industrial developments. I also would just like to find sellers with, cap rate expectations of a 7 or an 8% versus a 4%. Just
good luck with that one.
Out there that I'm not the only one that feels this way. Industrial real estate, has an excellent story behind it. It's just really expensive compared to where it was 5 years ago.
Okay. And
Paul,
how about you? Okay.
Yeah, I think, it depends how much risk you want to take. I think if you're going for low risk, I think the industrial sector with like an Amazon lease is probably outperforms other almost no risk type of investments. On the medium risk, one thing that we've seen a lot of folks have interest in is at the mezz equity level in a cash flowing asset, especially with being able to refinance into interest only properties. The multifamily is becoming interesting because it's gone from a 7% cash on cash to a 12 or 13% with some of this new IO 2.7% financing, which then creates the opportunity for this mezz equity tranche that is very well covered. The debt coverage ratios for 7 to 10 years are two times or something because of the IO function. So mezz equity investing in a cash flowing asset with this, you can get 11 to 13% returns. And then from a high risk perspective, I agree with Darren. I think, or even Chad maybe mentioned this. I think those are going to be coming in the third, fourth quarter into the first quarter of 2022, and it's really where the distress is. And so basically, I'm kind of focusing. Let's stay somewhat safe for now, and then be ready for the opportunities. Then separate from just we have other multifamily projects that we have ongoing, but. Yeah.
Paul, that's a great view. And thanks for sharing that. That's actually what I was writing down and preparing to answer my question. It is all about risk, right? And so Paul did a great job. I won't reiterate. I just want to emphasize that that's where you have to decide where to put, money, where I decide where to put money. Which bucket of capital am I deploying? The low risk, right? Or the high risk and everything in between.
Well, I don't know how many of our students we have on the call today, but it's been a great topic of debate amongst the students, many of whom are ready to launch their real estate career and look at each of you professionally and individually and say, well, how did they do it? And I'll just share one of the polls that was done, this is probably about 3 weeks ago, as to where the greatest mispricing opportunity was. The students came back and said it was in retail, that well-located retail, people are bailing to get out of that. And so if they're selling it at a 10 or 11 cap, and if it's in a good location, you can afford to sit on it a while. And then if you can figure out the next use, whether it's as distribution or service retail, that's the place to go. So none of you said retail, but that was kind of their feedback. And some of it's maybe influenced by the classes they take as well, I hope. But I thought it was an interesting perspective, actually looking at where that bid-ask pricing spread was. So we are at the witching hour. And I want to thank everybody who has joined us today for doing so and taking the time to listen. I think this was wonderful. And I want to thank the audience, the virtual audience. I hope we can see you next year. Also want to thank our panelists, Jess Ostermick from CBRE, Chad Brue of Brue Baukol Capital Partners, Darren Powderly of CrowdStreet, and Paul Books of Palisade Partners. Also, I want to thank Rich Wobekund and his staff, as well as Laurel Page and the Leads team, for researching, conceiving, and executing this week-long program on the Colorado economy sector by sector. As a reminder to everyone, all the attendees are going to receive an email next week with a link to the recording of this section, as well as a survey. We really encourage your feedback as we're trying to figure out how to reach the community virtually. So I thank you in advance for taking the time to doing the survey. Also, you're invited to, and I hope you'll join us at our next session, which is tomorrow at 12 o'clock Mountain Standard Time. And the Center for Ethics and Social Responsibility is going to be presenting a panel on the future of diversity, equity, and inclusion in business. In the meantime, thank you all. Have a great rest of your day and a good upcoming holiday period. Thank you for your time. And go Buffs. Thank you, panelists. Thank you.
Thanks, Mike. Appreciate it.